Hello everybody, here we are again. What we're going to do today is we are going to finish up chapter 22, which is on budgeting. We're going to go over that homework that I assigned. And then we are going to start chapter 23, which will be the last chapter that we cover in this class. So we are getting to the end. But let's go ahead and go right on to the homework. The first one I asked was Quick Study 2213, is that right? Yep. Okay. That was a real tough one, wasn't it? Did you do this one? Anybody? You didn't even do this one? This one was easy. We had a lot of people who didn't do their homework. We have a lot of people who made poor decisions in this class, didn't we? So hopefully you at home, you did your homework. Maybe someday you can manage these people because they didn't do their homework. Yes, that's exactly right. Okay, following are selected accounts for a company. For each account, indicate whether it will appear on a budgeted income statement, budgeted balance sheet, or if an item will not appear on either, label it NA. Okay? All right, sales, what do you think? If you didn't do it, you can probably do it now. Budgeted income statement. Office salaries paid. Budgeted income statement, correct? Accumulated depreciation.
Balance sheet.
Budgeted balance sheet. Amortization expense.
Income statement.
Budgeted income statement. Okay. Interest paid on notes payable.
Income statement.
Budgeted income statement. Cash dividends paid.
Income statement.
Actually, no, because that goes on the statement of retained earnings, right? So it's neither on the balance sheet nor the income statement. So that is an NA. Go on the statement of retained earnings. So we did a budgeted statement of retained earnings. Bank loan owed.
Balance sheet.
Budgeted balance sheet. Cost of goods sold. Budgeted income statement. Very nice. Okay. So any questions on those? That wasn't too hard, was it? Okay. All right, let's go ahead then and take a look at exercise 22-3. Okay. All right, exercise 22-3. All right, let me get that up there. Okay, use the following information to prepare the July cash budget for ACCO Company. It should show expected cash receipts and cash disbursements for the month and the cash balance expected on the end of July. Okay, the beginning cash balance of July 1st is $50,000. Cash receipts from sales, 30% is collected in the month of sale, 50% is in the next month, and 20% in the second month after the sale. Uncollectible accounts are negligible and can be ignored. Sales amounts are, and then they give those to us for May, June, and July. Payments on merchandise purchases. 60% is paid in the month of the purchase and 40% in the month following. And then they give us the purchase amounts for June and July. They tell us the budgeted cash disbursements for salaries in July. They tell us the budgeted depreciation expense for July. Other cash expense budgeted for July is $200,000. Accrued income taxes due in July is $80,000. And the bank loan interest due in July is $6,600. They give us a check figure over here, $122,400. Okay? All right. Well, the first thing that we need to do is we need to figure out our cash receipts from sales as well as our cash payments for merchandise. Okay? So, let's go ahead and go down here and do that. All right. Let's take first a look at, all right, let me straighten this up, at the cash receipts in July from sales. Okay? Henry, is that what you got? 1.364 million?
Yeah.
It is? Okay, anybody else get that?
Mm-hmm.
Matt, you did? Okay. And in July, they'll receive 20% of May's sales, 50% of June's sales, and 30% of July's sales. And this is just based on that collection pattern that they said. I think we've done these before, haven't we? Okay. So that has a little tick mark there. We'll take it up to the schedule here in a minute. But that is the supporting calculation for the cash receipts from sales, or the cash receipts in July from sales. Okay? We use similar logic for the cash disbursement in July for merchandise. Okay? That would be 40% of the 700,000, as well as 60% of 750,000. Okay? Which would give us 280 and 450,000, totaling up at 730, and we'll take that up here in a second. But these are the two supporting calculations that you really need to do before you do the cash budget. Okay? All right, once we have those numbers, the 1.364 million and the 730,000, let's take a look at the answer in its entirety. Okay? A little too much zoom there. Okay, we have our beginning cash balance, which was given. We have our cash receipts of 1.364 million, which we calculated below. Those added up together give us the cash available. Then we have our cash disbursements. We have our payments of merchandise of 730,000, which we did down below, right? We have salaries, we have other expenses, we have accrued taxes that are going to be paid out in July, and we have the interest on the bank loan. The total of those disbursements is this number right here. That minus that equals an ending cash balance of 122,400. Okay? Now, there was one item that they gave us information on that we did not list. What was that?
Depreciation expense.
Depreciation. Why did we not list depreciation expense?
There's no cash involved.
It is, yeah, correct, Henry. It is a non-cash expense. Remember us talking about that in the cash flow statement? Depreciation expense does show up on the income statement, but do we write a check for cash? If we have depreciation expense of 50,000, can we trace it to a check that we wrote for 50,000? No. So we do not, taking a look at this cash budget again, we do not include depreciation expense in here because this is a cash budget. And there is no cash disbursement for depreciation expense. Cool? All right. Good one. Questions on 22.3? Any questions on that, guys? All right. If not, let's hop over to exercise 22:17. Okay? All right. I know these take a while, but got to do your homework. Got to do your homework if you want to perform well in the tests. Okay, now here is 22:17. Let me put it up in its entirety on the screen. Okay. And I'm going to do this one a little differently as far as presenting the answer. But that, okay, what they want us to do, the following information is available for Zetrov Company. What they want us to do is they want us to prepare a budgeted balance sheet for March, okay? They want us to prepare a budgeted balance sheet for March. So what I'm going to do is I'm not going to read through this now. I'm going to actually read it as we're doing it, and let's fill in the balance sheet as we're reading it, okay? So let's hop over to the computer. And what we are going to do is we are going to do a budgeted balance sheet for March for Zetrov Company, okay? So we're going to fill in things as we read them. All righty. Okay, we'll label this up there at top. Zetrov Company budgeted balance sheet as of March 31st. Okay, the first item they say is the cash budget for March shows an ending balance, an ending bank loan of $10,000. Okay, so we have a bank loan payable of $10,000 and an ending cash balance of $50,000. So these items we just read, right? See what we're doing here? Okay. B, the sales budget for March indicates sales of $140,000. Accounts receivable are expected to be 70% of the current month sales. Okay, so we can figure out our accounts receivable, and that's $98,000. That's 70% of that $140,000. Okay? Item C, the merchandise purchase budget indicates $89,000 in merchandise will be purchased on account in March. Purchases on account are paid 100% in the month following the purchase. Now, ending inventory for March is predicted to be 600 units at a cost of $35 each. Thus, we know our merchandise inventory is $21,000. That is the 600 units times the $35 per unit. So we can figure up our total current assets here as $169,000. You with me so far? Okay, the budgeted income statement for March shows net income of $48,000, depreciation expense of $1,000, and $26,000 in income tax expense were used in computing net income for March. Accrued taxes will be paid in April. Okay, we have income taxes, we have an income tax liability, income taxes payable of $26,000 from reading that, okay? All right, and they said what our net income was, right? We're gonna use that here in a supporting calculation over here in a minute. So let's go ahead and just list that. All right. Let's see what else we have here.
Depreciation expense.
Yeah, let's go ahead and, though they said depreciation expense is $1,000, is that what they said? Okay, so we'll list that here too. Why do we want those items? Well, let's go on to item E and we'll read it and we'll know why. The balance sheet for February shows equipment with $84,000 with accumulated depreciation of $46,000. Okay, so the beginning balance, we're going to do our supporting calculations over here. Our beginning balance of accumulated depreciation is $46,000 then, right? Well, we have our depreciation expense of $1,000 that we just read about. Thus, our ending balance for accumulated depreciation is $47,000. Are you with me? Okay. Let's keep reading. Okay, let's read item E still. The balance sheet for February shows equipment of $84,000, so we can list that there too, right? So now we know the net book value of the equipment. Okay. Accumulated depreciation of $46,000, we just read that. Common stock of $25,000, right? And ending retained earnings of $8,000, okay? Ending retained earnings of $8,000. Now that was for February, right? So the beginning balance for March of retained earnings is $8,000. We add our net income of $48,000 and we get an ending balance of retained earnings of $56,000, okay? So our retained earnings are $56,000. All right. Oh, what did we forget to put up there? Accounts payable. What are our accounts payable? Well, we go up to item C. It said purchases indicate that $89,000 in merchandise will be purchased on account in March, and it'll all be payable the next month. So we have a liability of $89,000. Is that correct? Say we need to do some totaling up here, but does everybody, any questions on where we got the numbers that are showing? Okay, now we're going to add these two numbers to get our total assets of $206,000. Our total liabilities are the sum of these three, and that is $125,000. Our total equity is the sum of those two, that is $81,000. If we add these two amounts, we get $206,000. And that's our total liabilities and equity. So I think we have everything, don't we? Okay? That's a little bit more of a difficult one. You got to kind of just create the balance sheet as they give you these items. And you have to do these supporting calculations. Now these supporting calculations over here, those would not be on the balance sheet. This might be a footnote or something to it. The balance sheet is this part right here. the budgeted balance sheet is. Okay? Correct? All right, any questions on that, guys? All right, we have one more. Okay? Let's take a look at it. Exercise 2218. This one I think was a little bit easier. Okay, this one right here. Fortune Inc. is preparing its master budget for the first quarter. The company sells a single product at a price of $25 per unit. Sales in unit are forecasted at $45,000 for January, $55,000 for February, and $50,000 for March. Cost of goods sold is $14 per unit. Other expense information for the first quarter follows. Prepare a budgeted income statement. Now, what period are we doing it for? For the first quarter, which is January, February, and March, right? And then they give us this information right here. Commission is 8% of sales. Rent is $14,000 per month. Advertising is 15% of sales. Office salaries are $75,000 per month. Depreciation is $40,000 per month. Interest is 15% annually on a $250,000 note payable, and the tax rate is 30%. Okay? All right, well, we have to do some supporting calculations first. And let's take a look at those. The first thing we need to do is figure out what our sales dollars is going to be. Okay? So, sales dollars, the unit sales for those 3 months are as shown, right? So that's 150,000 units for the first quarter. The unit sales price is $25. So our sales dollars will be $3.75 million. Okay? All right, we have to do a similar analysis for cost of goods sold. We have the same number of unit sales, the 150,000, by taking each month's unit sales. What did they say the unit cost was per item? 14 bucks. So the cost of goods sold in dollars is $2.1 million. Okay? So let's take a look then. Now that we know those numbers, let's take a look at the complete answer. All right. All right, zoom out a little bit. We'll just go through these items. Okay? All right, well, sales and cost of goods sold, we derived just a few seconds ago, right? Via those calculations. That gives us gross profit of $1.65 million. Okay? Now let's take a look at our operating expenses. Well, our commissions expense are 8% of sales. Okay? They give us that. So 8% of $3.75 million is $300,000, right? Rent expense, they say, is $14,000 per month. There's 3 months in this quarter, so 3 times 14,000 is 42,000. Okay? Advertising expense is 15% of sales. So 15% times 3.75 million is 562,500. Okay? What about office salaries expense? Well, they tell us it is 75,000 per month. We have 3 months, so it's $225,000. Okay? Depreciation expense, they tell us, is 40,000 per month, right? We have 3 months, so it's 120,000 for the quarter. Interest expense, okay? Well, what do they tell us about that? It's 15% annually on a 250,000 note payable. So you take the 15% times the 250,000 times 1/4 or 3/12. That's how much they'll pay in that quarter, the 9,375. The total of those operating expenses is 1,258,875. And then we get net income before taxes of 39,125, right? They tell us that the income tax rate is 30%. So what is 30% of that number? It is 117,338. You might have needed to round there. That's fine. Our net income before tax minus our income tax expense gives us a net income bottom line of 273,787. Okay? All right. Once again, a little bit more difficult one of a homework problem. Okay? So, any questions on that? Anybody? All right. Great. Okay, we are officially done with chapter 22, except for your chapter 22 Connect assignment. Okay? So you guys can go out there and do your chapter 22 Connect assignment. One thing I want to caution you on is on your chapter 22 Connect assignment is, and I think I noted this in the instructions, and they have it noted there too, but if you're the type of person that doesn't read instructions, you can get in trouble, is make sure you really focus on those instructions. One of the things they're big on is items that are being deducted need to be in minus signs, okay? So let me see if I can find an example of that in one that we have done. Hold on a second. All right, I don't think we did this one, but just as an example. Like, if you are doing this budget right here and you're subtracting beginning inventory to get units to be produced, when you enter that into your Connect assignment, don't enter it in as 75,000, even if you are planning on deducting it. If it's going to be deducted, put the parentheses around it. Does that make sense? So make sure you do that on this chapter 22 Connect assignment. Okay, Luke?
So Connect will be able to read us putting the parentheses rather than a negative sign? Is that what you're saying?
I think you can do either one. I think it might, if you put a minus sign, I think it changes it to a bracket, but I think
see.
you should be able to. Does it, Matt?
I think so.
Yeah.
Sweet.
So just make sure you read the instructions real carefully. I think the most important parts are in red, okay? So don't, if you're the sort of person that skips instructions, try not to do that this time. Okay? Now what we're going to do is we are officially going to shift gears here, okay? And we are going to start talking about chapter 23. Chapter 23 is on flexible budgets and standard costs, okay? This is the last chapter that we'll cover in this class. Now, we're only going to go a couple slides into this right now, but we're going to talk about using some of this information that we have learned to manage our company and the use of budgeting to control and manage our company. Okay? We develop our budget from our objectives. Then we know that we compare the actual budget, the actual with the budget, right? The actual numbers that we achieved with the amounts budgeted to see what sort of variances or differences that we have. We're going to look at those larger variances and take action and try to fix them, and then we'll go through the whole thing again. Okay? Now, I'm going to go through another example with lawn mowing. I don't know why all my examples have to do with lawn mowing, but it seems like a good simple company to explain. So what we're going to do now is I'm going to close this out, and we are going to work through a problem on Excel. And I don't want you all to take notes on this, okay? For you folks that are here, I'm going to give you this when we're done, okay? But I don't want you writing it down, and I don't even want you looking ahead. I want you just to listen, okay? Just to watch and listen. I think it goes better if you are chronologically following me why we developed this. But you don't need to take the time and effort to write all this down. I'll give this to you, okay? For you folks at home, this is in your handouts, but try just not to look at it while we're working on it. Try to just look at the screen and see the logic that we're working with, chronologically, how we're developing this, okay? So let's just focus on this screen, and I'll show you what we're going to do here, okay? Henry, let's say that you are going to start a lawn mowing company, okay? At the end of the spring semester, and you're going to mow lawns in the summer months, just June, July, and August, okay? Now you want to develop a budget for your lawn mowing company, okay? You kind of want to do a budgeted income statement, so to speak, for your lawn mowing company for June, July, and August. Now you're not going to do 3 monthly budgets. You're just going to do one budget for all 3 months combined for the summer, okay? So you're trying to figure out what sort of items you need to budget. Well, you know you need to budget your revenue, right? And you also know that you're going to have some cost items that you need to budget for, such as, now you own your own lawnmower, but you're going to have to put some gas in it to make it run, okay? You're going to rent a shed to keep the lawnmower in and the gas in, and you know, maybe some other little small tools and stuff like that. Okay, so you're going to have a cost of the shed rental. You're going to have a little advertising cost. You're going to advertise in the Kansas City Star weekend newspaper. Okay, and let's say you have a neighbor who is a high schooler, and you're going to pay him some wages to help you with this. Are you with me? Okay. So now there's probably more cost items, but we want to kind of keep this simple. So for your lawn mowing company for the summer, these are the things that we want to do a budget for. Okay. So you start to work on your budget. Now you estimate that you're going to mow about total 100 lawns for the summer. Okay. And you charge about $50 per lawn. So you're budgeting total revenue for the summer of $5,000. You with me? Okay. You think you'll spend a total of about $700 in the summer on gasoline. Okay. In regards to the shed rental, you budget an amount of $150 because you're paying $50 a month for each of those 3 summer months. So 3 times 50 is 150. You following me? Okay. In regards to advertising, you're going to run a weekend ad on Saturdays, and it's going to be about $25 a weekend. There's 12 weekends, so 25 times 12, 300. You with me? Okay. The total wages that you think you'll pay this high schooler for the summer, $1,600. So your total cost that you're budgeting for the summer is $2,750, which is the total of these. You with me? And you can figure out what your budgeted net income is as well, right? It's the $5,000 minus the $2,750 equals the $2,250. You following me so far? Okay. Now, the summer comes and goes. Okay. And we now have actual amounts for all of these items. Okay. These are just actual amounts achieved. You just look at your accounting records, what you paid and what you received. And we see that the numbers that we got, well, we actually received $5,200 in revenue. Okay? Gasoline, you actually spent $730 on. The shed rental, you actually spent $170 on. Advertising, you actually spent $285 on. The wages of the high school you actually paid out were $1,690. That's total costs of $2,875, and then an actual net income realized of $2,325. Are you with me? Okay. So now we have our budget, we have our actual, and what we want to figure out is our differences. Okay. So what's the difference between $5,000 and $5,200? $200. Now we also have to decide if this is favorable or unfavorable. Okay? Well, you budgeted for $5,000 in revenue. You actually achieved $5,200 in revenue. Is that favorable or unfavorable? Favorable. That's favorable. All right. Gasoline, you budgeted for $700. You actually spent $730 on gasoline. That's a difference of $30, right? Is that favorable or unfavorable? That's unfavorable, right? Now, we don't show positive and negative numbers here. We just show positive numbers, and we indicate with F and U. What does F and U stand for?
Favorable and unfavorable.
Favorable and unfavorable, right? Okay? So we use favorable and unfavorable as opposed to positive and negative signs. Now, you got to be careful. When your revenues are greater than your budget, that's favorable, right? When your actual expenses are greater than your budget, that's unfavorable, right? Okay. All right, shed rental. You budgeted 150. You actually spent 170. That's a $20 difference. Is that favorable or unfavorable? Unfavorable. Advertising, you budgeted 300. You actually spent 285, and that is $15. And what is it? That's favorable. You actually spent less than what you budgeted. The wages of the high schooler, you budgeted for $1,600. You actually spent $1,690. That's a $90 difference, right? Is that favorable or unfavorable?
Unfavorable.
Unfavorable. Okay. Now, we can figure out our total cost difference. You could just compare these two numbers. Your budgeted total cost was $2,750. Your actual total cost was $2,875. That's a $125 difference. Is that favorable or unfavorable?
Unfavorable.
That's unfavorable. Now, you could also net these numbers out to see what the net favorable or unfavorable amount was. In this case, those four numbers net out to a 125 unfavorable amount. You following me? Well, now we can also figure out our net income difference. $2,250, $2,325, that's a $75 difference. That is favorable, is it not? Because you budgeted for $2,250 income, you had $2,325. You could also net out the $200 favorable with the $125 unfavorable for revenues and total costs respectively to get your $75 favorable. Are you with me? Okay. Aren't you glad you don't have to write all this down? Okay. Now, we have a problem, however, okay? And here is the problem. When it was all said and done, Henry, when the summer was over, you actually mowed 110 lawns. So these actual amounts are based on your actual activity level of 110 lawns. Now, do you see the problem there?
10 loans that weren't paid $50 each.
Well, there's something askew, isn't there? But think about this. When you did your budget, Henry, you were budgeting for 100 lawns. You actually mowed 110 lawns. That's 10% more lawns than what you had budgeted for. If the activity level that was actually achieved is different from the activity level you budgeted for, there should be no big surprise that some of these amounts are different. But when you look at the screen, these amounts have problems because we don't know if these differences, guys, are in regards to poor or superior cost and revenue management or simply due to the fact that the activity level was different. So these amounts right here, I'm going to kind of highlight this in kind of red. These really are just not that helpful because we just don't know whether these differences are due simply to a change in activity or what. Are you with me? So what we want to do is we want to recognize the fact that the budget that you originally prepared, Henry, was what we call a fixed or static budget. It is prepared at one activity level. And that activity level was at 100 lawns. The actual achieved was 110 lawns. Thus, we have problems with our differences. So what we want to do is we want to explore the concept of fixed or static budgeting versus what we call flexible budgeting. We want to what we call flex the budget. The whole idea of a flexible budget is if you can tell me what your activity is, I can tell you what your revenues and expenses should be at that activity level. And then you can compare those flexible budget amounts to the actual amounts achieved. You following me? Now, the first step in doing this, folks, is we have to classify each one of these items as variable or fixed in relation to the activity level. And what is the activity level specifically, conceptually, in this example?
Number of lawns.
It's the number of lawns mowed, right? Okay, so let's go through these items and let's classify if they are revenue or if they are fixed or variable. in regards to the number of lawns mowed. Okay? What about revenue? What do you think?
It's variable.
It's variable. The more lawns we mow, the higher our revenue will be. What about gasoline?
It's variable.
It's variable as well. What about the shed rental?
It's fixed.
It's fixed. We said it was $50 per month, right? And the advertising is also fixed. $25 per weekend times 12 weekends. What about the wages of the high schooler?
Variable.
variable.
That's variable. All right. Now what we want to do is for those items that are variable, we want to figure out the formula for that. Now we can use this fixed static budget information to derive these formulas if we are just cognizant of the total amount and the activity level that you budgeted it at. Okay, to give you an example. If Henry budgeted a total of $5,000 of revenue for 100 lawns, basically what was the variable formula he was using per lawn? What's the sales price per lawn?
$50 a lawn.
$50 per lawn, right? Now we don't do this for fixed items, right? We just do it for variable items. Gasoline is variable, however. If he budgeted a total of $700 to be spent for the summer for 100 lawns, basically what is he budgeting per lawn? $7 a lawn. Okay? If he budgeted a total of $1,600 for 100 lawns, basically what is he budgeting per lawn?
$16.
$16 per lawn. Cool? You with me? Now what we can do is using this information, we can derive our flexible budget. And this flexible budget, what do you think the activity level we will flex it at will be?
110.
110 lawns. Because the whole key in this thing is that we want the budget and the actual to be at the same activity level. Therefore, the differences will be meaningful. They won't be due perhaps to just simply a change in activity level from what we predicted. Okay? So now let's do our flexible budget. If Henry budgeted $50 a lawn in revenue times 110 lawns, what is the total revenue for the summer? $5,500, right? 50 times 110. If he budgeted $7 a lawn for 110 lawns, what should be the total flexible budget number?
770.
770. Now, for the fixed amounts, he budgeted $150 and $300 for shed rental and advertising, respectively, right? You recognize that would be the same amounts he would budget at 110 lawns because those are fixed. Those have nothing to do with activity level. You with me? I thought I highlighted that. Did I not? Okay. $50 a lawn times 110 lawns is $5,500. You with me? Got to back up here. Okay. $50 a lawn times 110 lawns is $5,500. $7 a lawn times 110 lawns is $770. And these amounts are fixed. Right? Now we're back on track. If he budgeted $16 per lawn times 110 lawns, that one's a little more, can't do that in your head, but that's $1,760, isn't it? You with me? So, his total budgeted costs at the flexible budget 110 lawn level is the sum of those four numbers, which is $2,980. And his net income at the flexible budget activity level of 110 lawns would be $5,500 minus $2,980 equals $2,520. Are you with me? Now we can figure out some meaningful differences. Okay? Some meaningful differences. The difference between these two numbers is 300. Is that favorable or unfavorable?
Unfavorable.
It's unfavorable. Why, Matt? I agree with you.
Because he's $300 under what he budgeted.
Yeah. His actual revenue achieved for 110 lawns was $5,200 versus the $5,500. The difference between these two numbers is $40. Is that favorable or unfavorable?
Favorable.
That's favorable. He spent less at that activity level than what he budgeted for gasoline. Okay? The difference between 150 and 70 is $20, and this is unfavorable. The difference between these is 15, and that is favorable. Okay, so these amounts right here are going to be the same amounts here because again it's fixed. Okay, but we have a $20 unfavorable amount for shed rental, a $15 favorable difference for advertising. Okay. Now some might say, before we move on, they might say, well, wait a minute, Dave, how could there be any difference here in regards to the shed rental? And the same thing with advertising. These are fixed. These are supposed to be predictable. Now let me remind you of something. Just because something is a fixed cost does not mean it's 100% predictable and that we'll always have zero differences between our flexible budget and our actual. Okay? Just because a cost is fixed does not mean it's 100% predictable. For example, property taxes on a factory are fixed, are they not? Do you think you will predict exactly what your property taxes will be? No. Now looking at this example, let's just kind of make up a little story as far as why your shed rental might be different than the 150 in actuality. Well, maybe you were putting your mower in one night and you hit the door wrong to the shed and you busted off one of the hinges. So you told the guy, well, hey, I busted a hinge on your shed, sorry about that. And he said, no big deal. He goes, I'll go buy a new hinge and some parts and I'll fix it. He goes, I'm going to charge you for it. He said, that's fine. Well, it costs $20 to fix the hinge on that door, and he makes you pay for it, right? Well, you'd probably put that $20 in your shed rental. That's probably the expense you would debit it to, right? Okay, so that might be why that's more. A reason that advertising might be less, looking at the screen, maybe you had a $15 off coupon that you asked if you could use. And they said, yeah, we'll let you use the $15 off. So they actually let you take $15 off one of the weekends, and thus your advertising was a little less than what you budgeted. You with me? Okay. Fixed costs are not 100% predictable, and they will have differences, even at the flexible budget logic. Okay? All right, wages of a high schooler. You budgeted them at $1,760. The actual amount was $1,690. That's a $70 difference. Is that favorable or unfavorable? Favorable. Okay? So if we add these up, that's a 105 favorable, or you could simply compare those two numbers. And then if you do a net income between these two numbers, a net income difference, that's $195 unfavorable. Or you could net out a $300 unfavorable revenue difference with a 105 favorable cost difference, and that would net out to a 195 total net income unfavorable. You with me? Now, these are really our meaningful columns right here. I'll make those in green. Okay? Now, do you see where the meaningful differences based on a flexible budgeting methodology is a lot different than the differences in regards to a fixed budget, right? Okay? These numbers were kind of worthless in the red, right? You have to understand this flexible budgeting logic to be able to get meaningful numbers. These are quite a bit different. If somebody didn't understand flexible budgeting and they figured out these numbers, they could come to a lot of incorrect conclusions as a manager, right? Oh, we did great. That's a $75 favorable variance on net income. Well, it's actually $195 unfavorable, okay? All right, now, the better way to prepare this is actually like as shown here, okay? This is that same information above in green, except we did it in a contribution margin format. We listed out the revenue, then we have our variable costs, okay, for gasoline and the wages of the high schooler. Revenue minus our variable costs is our contribution margin. Then we had our fixed costs for the shed rental and the advertising, and then we had our net income. We put our flexible budgeting numbers here. We put our actual results here. Notice that it's at the same activity level, okay? Because this is a flexible budget. Then we have our variances over here, and this is all the same information as above. It's just put into a more concise report in proper form, okay? You follow me? Now again, I'm going to give you all a handout that has all this information on it, but I think it's easier to just follow the logic as we chronologically move through it, okay? Any questions on any of that? Anybody? Blake?
How, if you did 110 lawns, how come he only got $500 in revenue? Like, how'd that actual?
Okay, that's a good
There.
question. Well, I think you meant if you mowed 110 lawns, why did you only get 5,200 in revenue?
You mowed them at a fixed rate.
That's a great question. Well, maybe there's a lot of differences. Now he budgeted that he would ask $50 per lawn, right? For sales.
Not everyone's gonna pay 50.
But maybe somebody won't pay $50, or somebody said, "Hey Henry, come on, you're my buddy. Will you do it for 40?" And you're like, "Okay, I'll do it for 40." Okay? Or maybe when you were mowing, you ran over a sprinkler head and you broke it. And so they said, "Well, we're not going to pay you for this. We're going to have to buy the sprinkler head, so we're not going to pay you for that one." There could be a number of different reasons then that actual revenue achieved is different than what you budgeted for. That's a great question, though, Blake. You see what I'm saying?
Yeah.
We can think of a lot of different scenarios. Somebody said, "You promised you would mow this last week. I'm not going to pay you full price because you're late."
But wouldn't
Okay.
you want to budget with those expectations?
But he might have. He might have. Now, I don't know. Maybe he actually thought that he was going to try to really get 55 or 60. And so he budgeted for 50, but he just didn't budget, enough. So, again, but this is helpful for him, right? It's helpful for him to know that, I really thought at 110 lawns I would have revenue of 5,500. And yet I only have 5,200 of revenue at 110 lawns. As a manager, he can start to unpack that and see what the problem was. And maybe the problem was some of those things that we talked about, some of the difficulties that he faced. But we know that that difference is a meaningful difference. It's not just an activity level difference. Great question. Other questions? Okay. One thing about life is we budget for things and then life happens, right? Okay? If you've ever made personal budgets, that you know this, right? Things change. Gasoline prices change. Things break. Okay? People won't pay maybe and you wanted them to pay. There's a lot of reasons that actual results can be different than budget. But we want to have those variances be meaningful so they can help us manage and control our business. Okay? Cool. Other questions?
You get dual credit for an accounting and a philosophy class.
Yeah, this is accounting and philosophy. Yeah, definitely. There is probably some philosophy term for what I just said, but I don't remember it. Okay, I only have one homework question for you to do, but I really would like you to do it, okay? And what it is, and I'll pass this out after the cameras stop rolling, but it is this Chapter 23 Flexible Budget homework question for Bruce's A1 chimney sweep, okay? This is a whole page, okay? And it really is going to be walking you through doing something that is exactly like what we did with the lawns, okay? So if you think back to that or rewatch the video, that should help you as you prepare this. The other thing you can look at, as I say down here at the bottom, is take a look at Exhibit 23-4 in your textbook on page 952. That will give you some guidance as well. Take a look to see what your textbook has to say about flexible budgets as well. And you can also look, and I haven't given this to you folks yet, but in your Chapter 23 slides, they walk through a flexible budgeting example in the PowerPoint slides. I just don't like it as well as the lawn mowing one. I think the lawn mowing one is clearer. So, but if you want to look at what the PowerPoint slides had to say about it, do that as well. But do that Bruce's A+ chimney sweep problem for next time, and we will see you later. Remember to do your Chapter 22 Connect as well. Bye-bye.